Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Invest in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we want to make the best investments that we can. So thank you so much for joining us. On today's show, we have Mark Bern. We've had Mark on the show before and had a great time together. Today, we're going to specifically follow up a recent article series that Mark has been doing as he's been tracking second quarter earnings reports. And he's had a series of articles called Earnings Heading in the Wrong Direction. And one of the things he's been tracking there is first of all, the negative direction the earnings have been going of late, and also how the increasing trend of companies more and more reporting non-GAAP earnings as opposed to GAAP earnings. And there's a number of trends like that that are veiling the fact that while on the surface it may seem like a lot of companies are doing better or are performing really well when it comes to earnings, but when you dig under the surface, most companies and overall the indexes as a whole are trending significantly downward when it comes to earnings. This is significant information. This is helpful news when it comes to investments and understanding big trends in the markets. And Mark does a great job of explaining it much better than me, so I hope you'll hang around and enjoy the rest of the show. Remember, our goal here is to help you learn to invest. That's financially and in all of life. You can always find more at investorinthefamily.com. On September 12th, the second online investing conference will kick off. If you want the top two highest conviction premium access only picks from Brett Jensen and Cody Willard, you can still sign up for the online investing conference for free up until next Wednesday, September 7th. So go to the onlineinvestingconference.com and sign up for free. After that, the price jumps to $99, and the conference goes live online on September 12th. Normally, this access would cost hundreds or thousands, not hundreds of thousands of dollars. So anyway, I hope you will take advantage of this unique opportunity. If you want to sign up for an email list and get an email about how to sign up for the conference, text the word join family to the number 44222, or just go to investorinthefamily.com. Again, that's onlineinvestingconference.com. I hope you'll take advantage and enjoy the conference. And for now, I hope you'll enjoy this interview with Mark Bern. Well, hey, Mark, welcome to the show.
Well, thanks, Brian. Glad to be here.
Well, it was an honor to have you with us last time, and I'm excited this time to jump into some of your more recent content that you have been sharing on Seeking Alpha. You've written a series of articles about second quarter earnings reports, and each of them had the title Heading in the Wrong Direction. And then you had successive week 1, week 2, week 3, part 1, part 2, part 3. Very exhaustive coverage. And I'd love for you, if you don't mind, just kind of giving those who maybe have read the articles or haven't read them yet, can you give us a little bit of your thesis of what you're seeing or what you saw with quarter 2 earnings?
Well, there's two pieces to what I want to do about earnings. I just really want people to understand that earnings are not as good as they're being the headlines seem to be saying. There's a big difference between the earnings are being reported as most of them over 60, almost 70% beat estimates, consensus estimates. And that's what the focus is on. And I want people to think about that and realize that it's not beating estimates that's important. It's having growth in earnings that's important. And if you look at it, and I look at GAAP-based earnings because it doesn't change. The standards are pretty much, well, they may be updated slightly, but the doesn't really change that much over time. So there's a comparability from one company to another, and then on a historical basis within for the same company. But when you take the non-GAAP earnings, which is what most companies are emphasizing and focusing on and discussing at length, the difference between GAAP and non-GAAP earnings is expanding. And that's going to be the second part of what my analysis. I'm just working on an article now today on a couple of companies that I just want to highlight how much the difference is. And so as an example there, just kind of precursor, Alcoa shows earnings that are 66.7% better than GAAP. I mean, I'm sorry, but anyway, but that's coming in the future. I'm going to go through line by line the things that they exclude from GAAP to get to the non-GAAP and explain, okay, this makes sense, or why I don't think it should be excluded. And I'll do that with a couple of different companies. But going back to the series that I've already written, five, I believe.
Right around there. Yeah, I'm looking at it.
I did beat 4 just recently, so 6. Different articles. And week 3 was just tons and tons of companies reporting. That's why I broke it into 3 parts. The thing about it is, I wanted to emphasize in those articles the difference between the earnings estimates and compare, the beats and a percentage, how much they beat, how many beat and how many didn't, and then compare the actual earnings to what they reported a year ago in the same quarter.
Interesting.
And so, and just put those side by side and let people see, well, yeah, they beat, but they, by 2 cents. So that's a positive, right? On the other hand, when you look at what they did compared to last year, like in week 4, it was like over 50% of the companies reporting in week 4 that I listed. I only listed 100 and some companies in week 4, and only those that had a market cap of over 10 billion, just to kind of reduce the numbers, because there were hundreds and hundreds and maybe 1,000 or more reported in week 4. Anyway, but I believe it was just over 50% of companies had declining earnings from quarter 2 of 2015. And why is this important? Well, early in the series, I mentioned that if you look at GAAP, and these I should step back. These reports were based on what they reported, which was not GAAP.
Right.
And there's still, a significant number of the companies are still are losing money compared to last year, or declining earnings compared to last year.
Yeah. Can I pause a moment too? And just, you talked about you're comparing this year's earnings versus a year ago. Are you seeing a difference in between the two as far as companies who are reporting GAAP versus non-GAAP? Like last year, were more companies reporting GAAP numbers than this year? Much more are reporting non-GAAP, or has that been consistent?
No, it's a trend that is rising. I don't go look at how many were reporting GAAP and non-GAAP last year compared to this year, but back around 2009 or 10, it was around 60 or 70. I think 2009 or 10, it was 70%. Were reporting non-GAAP, and a lot of them in their press releases did not include GAAP or reconciliation, but the SEC has required that now, and so they are, for the most part. I found a couple that didn't bother with GAAP, and several didn't do a reconciliation, but they should. But anyway, right now it's right at close to 90% of companies are reporting non-GAAP.
Wow.
So that's increasing, and the difference back in around 2009, I think the difference was around 10% or so difference between GAAP and non-GAAP. And today I read, I haven't tabulated it all, but the difference seems to be, or I read somewhere where it was close to 31% in one place, and then last quarter it was 26% or something like that. So the difference is growing. So non-GAAP is getting further and further stretched above GAAP, which tells me that they're doing everything they can to support the prices.
Right.
And, and here's an interesting thing. Early in the series, the first 2 or 3 articles of the series, I emphasized at least one paragraph explaining that if you use GAAP and go back to 2011 and compare it to 2015, we actually came in just under 2011 during 2015 on a GAAP basis for the S&P 500.
Wow.
Earnings per share. Now, that's earnings per share. And now consider that during that time, the S&P 500 companies have bought back about $2 trillion worth of shares. And earnings per share are still down.
Wow.
So a lot less shares and earnings per share are still down. That means the numerator must be dropping even faster, right? And which is the case. It has to. So it's just math. Anyway, so earnings
right.
earnings are down, from 2011 on a GAAP basis. But on a non-GAAP basis, they're up. But I just have a hard time accepting the non-GAAP when it keeps growing in its discrepancy from GAAP.
Well, I want to pause, and I just want to out of some applause for the way you're approaching this, because I get really excited when people look for truth and try to find like what is actual real data that can be used to make real decisions based upon. And it's that trend you described is fascinating. And it shows how many companies are doing whatever they can to continue to try to make things look good in spite of what may be the reality. And obviously there's different opinions in terms of how well the economy may or may not be doing. And I'm not sure if there are many people I know of that are pounding the table that the economy is doing amazing. Some will try to make an argument that it's improving on some level, but you get what you're saying does not seem to support that. And I like finding concrete things to look at. And so I'm a huge fan of what you're doing.
Oh, well, thank you. My next couple, 2 or 3 or 4 articles, I don't know how long I'll do it, depends on how many people read them, will be about the difference between GAAP and non-GAAP. And I'm just going back like 3 years compared to this year, quarter to quarter, same period, just to look at that. And the first ones I'm doing, I'm just taking a couple of companies and doing them line by line and saying this is, as I mentioned before, this is what's going on, and I don't agree with it, or I do. In some instances, I do, and it's perfectly fine.
So, what would be cases where you think it's good to go non-GAAP?
There are not many, but there are the one-time non-recurring events that really are non-recurring. Those things can be taken out. For instance, if a company does a merger and they have they write off a bunch of the expenses related to the merger in the year of the merger or the year after the merger, whatever, and they're done with that, other than the annual write down of maybe the amortizing the goodwill or something, but other extraneous stuff, that expenses that will not recur, that's fine if they only do this occasionally. But on the flip side of that, companies that buy 10 or 12 companies a year, smaller, obviously, they're trying to feed their growth through acquisition, and there are a lot of them out there. I mean, Cisco bought, I think, 11 companies in a year, and I mean that's not even a big year for them. I think IBM, of course, they got rid of some companies and they bought some more. So, and this is a constant thing that's going on. Oh, and I just came across something else today that should be interesting. Today, and I don't remember what year the base year was, but I think it was sometime around 2006. But there was a study done to see, or not really a study, just someone was comparing the number of stocks listed today in the U.S. compared to back then, and it's down almost 50%.
What do you think? What's that? Is that most? You think it's mostly acquisitions? The cause for that?
A lot of it's acquisitions, and then of course some companies are just throwing in the towel, going under. Right. So I don't know. I don't have a breakdown as to how much of either, but there are companies. I mean, you had well, in the energy patch alone, you're losing, probably, I don't know. Last time I saw was like 70 or 80 companies had filed bankruptcy, but that's gone up since I've looked. And Not all of those have gone out of business, but a number of them have, and they're it's just a natural thing. But this was a little unnatural,
right?
Circumstances this year. Anyway, so one of the reasons I see for the high valuations is that there's the same amount of money or even more money than there was back then chasing a smaller number of shares and a smaller number of companies. I mean, plus you've got all the new ETFs being created, having been created, and each one of those has to own so many shares or so many companies, shares of so many companies, and so on and so forth. So you've got a demand side that is chasing fewer and fewer. And of course, then there's also the foreign investors looking for some place to put their money to earn something, And of course, I think some of that's coming here, but that's not going to be forever.
Yeah, well, that comes back to the argument that, the U.S. is, as far as global economies, the best of a bad bunch. May not be great in itself, but it's the best option available. And so that's an argument for, the market should keep climbing or should stay stable, so on, because of all the reasons you just mentioned. What do you think? What do you like? You've also got a series of articles called "The Time to Hedge Is Now." How are those different series of articles coming together?
Okay, well, the hedging I don't do constantly. Some people, think I do, but I've been hedging for about 2 years now.
Okay.
I started mid-2014 in small way, and I'm getting more serious about it now. I generally, when I'm getting nervous, and it goes back to, I think it was the Buffett quote, you can have the top 10% and the bottom 10%, and I'll take the 80% in between and be happy.
Sure.
I don't necessarily sell all my positions at the top, but I will winnow out those, and I have a process for doing that. I won't go into detail on that, but I basically, if they get overvalued by too much, and we're in a situation where I believe we're close to the top, or could be, or way overdue for a recession, I'll take some profits off, at least part of a position, in some cases all of it. And usually I do that by selling calls above the market at a price I don't expect it to hit. And when it does, and if they get called away, I'm still happy, because it's a long-term holding. And it's in my tax deferred accounts. I don't do that in my taxable accounts, though.
Right.
I usually hang on for the long term because I don't like to pay the taxes. It's not that bad at 15%, but it's a bit, more than I'd like. So, but mainly I want to protect myself against a significant loss. For instance, if the market goes down 50%, I'd like to contain that down to 15 or 20%.
Because if you're using this system of hedging that you use,
using my system of hedging, and I don't proclaim my system to be, or my strategy to be, the best and only thing that should be done. Everybody has to find the strategy that works best for them, and this is just what I do, and I explained it in my series. And excuse me. What I tend to do, I try to look for quality companies, and one of the definitions I use for quality companies are those that don't drop as much as the rest of the market. In other words, when the market was down 50% or more, most of my holdings drop 30 to 40% or less. So I avoid part of it that way, and they also usually have less debt, lower payout ratios, more free cash flow, and a number of things. Anyway,
right.
And I look at each one based relative to its industry. So, because you can't just put what's the maximum amount of debt you would allow across all industries? Doesn't make sense, because some companies or some industries are just fine with 50% of their capital structure coming from debt. They're not going out of business. Utilities, for one, I mean, that's not an unheard of number. But in technology, that's ridiculous,
Right.
Okay. So anyway, but when I'm hedging, so what I do, I kind of flip that when I'm looking for hedge prospects or candidates, and I use options, and I use out of the money options, and I try to do 6 to 9 months out expiration. Expiration. Like now, I'd be doing at least January 2017, and at this point, I'm trying to look for some things going out even further than that. I prefer not to go out less than 5 months. Anyway, and I look for companies that historically have fallen more during a recession than the overall market. For instance, back in 2008 and 09, I look for, when the market overall was down 57% from top to bottom, I looked for companies that were down 80 or 90% during that same time.
And how did you look? How did you search for those? Did you use like a basic stock screener service to find those?
No.
How did you do that?
I just went through. I went through a lot of companies by industry. I looked at industries first.
Okay.
For how much the industries went down during that time, and then I went into those industries and looked at companies and just looked at their long-term charts. I mean, it's painstaking, long-term. Yeah. I should do it differently, but I like to have the visual. So,
but I think so often it's when people are willing to go that extra mile, like I said at the beginning, to get the hard data and find, I'll say, truth in the scenario that can really help serve to make better decisions. So I applaud that, because I think a lot of people aren't willing to do that much homework.
Yeah, and so then I also then look at the other aspects. If they're carrying more debt than the average company in their industry, that's another check off that I like. If they pay a dividend and have had a history of cutting their dividend during recessions, that's another check off. That's a big red flag, because that usually those companies get clobbered in a recession when they cut their dividend. I look for companies that have a high payout ratio, very thin coverage on debt and service, and so on and so forth. So, the companies that are going to be strapped for cash and will probably or may be forced to either issue more stock in order to recapitalize, or issue more debt and face a credit downgrade. I mean,
those are the type of companies that would fit your grid for your hedging process.
Exactly. And they don't all pay dividends, and they don't have all of them don't have all aspects. And if for some reason they held up, during the last two recessions, either one of them, I took them out. But a good example was Softbees. And if you were to pull up a chart for them and do it long term, and look at 2000 to all the way to the current, or even just through 2009, you'd see how they reached a peak, and then just when the recession hit, they tumbled. Reached a peak, and then when the recession hit, they tumbled. They went with the market up, and then when things went bad, they went bad. They went down far more than the market. And the reason for that, I mean, I always wonder why. So I try to find out, why did they go down? And in this case, Sotheby's, generally, when there's a lot of wealth being created, like in 2000, it was the internet, the .com phase. And there were a lot of new people making lots of money and becoming millionaires and multimillionaires, billionaires, and that sort of thing. All that new money. And they were, what do they do with that? Well, a lot of times, and this is crazy, but whenever there's a bubble in an asset, the people benefiting from the bubble tend to buy collectibles.
Right. Trying to find something to do with the money that they feel like maybe a little more diversified and stuff like that.
So you look for who's buying, and are they involved in a bubble? And if it is, then that's going to pop eventually. So I looked at that, and back then it was the .com in 2007, 2000. That period through 2009, it was housing. And here recently, if you look at China, the real estate and the stocks and everything have kind of leveled off and fallen back a bit. They had a bubble, and now money is moving out of China. And so Sotheby's has not gone down as much as it has in the past, but I have faith that they will.
Right.
I mean, the bubble hasn't burst. They've been propping it up, and China's in a position to be able to do that, or at least for a while yet. But and there are many. There are a lot of people who've gotten rich, especially in China, and they may still be buying collectibles, hoping that because maybe that's one place that will be a store of value.
I'd like to be able to keep the hedging ideas back in with the series as far as earnings heading in the wrong direction, because I think I would like to hear, I really like what you said as far as the GAAP versus non-GAAP and what earnings are doing when you look at them with GAAP numbers year over year. Do you have any more insight or thoughts as far as why earnings not universally, but it seems universally going in the wrong direction? You mentioned there's more money chasing less stocks. That's leading to overvaluation. Do you see anything else going on there that's a reason for concern?
Well, there's a couple of things we have to consider. I mean, transportation earnings are down because freight is down, and so that's kind of a good indicator as to the health of the economy. I look at one of many, and so that kind of has me worried that earnings are not what they're purported to be. But there are some strengths. I mean, I will be the first to admit there are some areas of strength.
Where do you see that?
Well, discretionary, consumer discretionary has been holding up, and of course, now utilities have done okay, but they're overvalued at this point, I think. And REITs have done great, but they're really slow growth, and so they've had a multiple expansion. Industrials have done poorly, but they seem to be bouncing back a bit, but they're not back yet. Most of them are not back. A lot of them, well, some are and some are not, but compared to last year, and last year was a bad year for them because many of them are involved in serving the energy and materials mining industries. And so when those fell apart last year, the earnings went down. So they've got very easy comparables. Last year we're down in the dumps, and this year it's easy to beat last year. So there appears to be some positive growth there, but it's off a very low base, and it's not showing the kind of strength that you would normally expect in a recovery situation. So it's still pretty weak.
I'm sorry, go ahead.
I'm just saying that I think we're really in approaching, if we're not there already, we're approaching a bubble situation. I mean, people hate me for this, and some of them, but they go ahead. I wouldn't be hedging if I didn't think we were there on a valuation basis. The zero interest rates have gotten people looking for yield anywhere they can find it. And that can only go on so long. I mean, the credibility of the Fed is starting to wane a bit, I think. When it falls apart, then the bubble pops. But I don't expect that to happen all of a sudden. I think that it's going to have some kind of event or circumstance that causes a recession to begin, and there's nothing that the Fed can do that's going to be effective from where it's at now.
When you say event, you thinking like global political or within the economy or any of the above?
Any of the above. I'm not going to try to pick one because,
Right. You're smarter than that.
I've listed dozens that could happen, in articles. So it could come from anywhere. Who knows what it's going to be? Trump could get elected. I don't know. I'm just kidding.
Right. Well, okay. You're fueling the comments. You're fueling the comments. There you go. We're going to get a nice and vibrant comment stream in this article. That'll be great.
Or Hillary could get elected. I don't know.
There you go. Exactly. I believe one of those two will happen. How about that? Well,
yeah, it could be. Yeah. I don't know what the result will be or the reaction will be for either.
Right. Yeah, it will be fascinating to see, and hopefully whatever happens will be positive. That's a very benign statement, but it's true. You mentioned some specific companies in your articles, the earnings heading in the wrong direction. Some big name companies like you already talked about Alcoa, Apple, BP, Amgen, Boeing, Comcast, AbbVie, some of those type companies. Are all those companies that are doing what you're saying, like they're reporting non-GAAP versus GAAP, and actually the earnings are declining versus what they appear to be presenting?
I can't say if they're all non-GAAP or not. I was listing the very large capitalization companies so that people at the top, so that people knew they could find them in the article if they were interested. I couldn't obviously list everything because there were 60 to over 100 in each one, except for the first one. It was shorter, but week one is always slow. But the majority, of course, are reporting non-GAAP instead of GAAP. They're all reporting both, the most of them, but they're emphasizing the non-GAAP.
Right. Okay. So in your articles, you're listing all the companies who had earnings that week, and then you're comparing whether they're using GAAP, non-GAAP, whether they've improved or declined.
Yeah, I'm not showing whether they're GAAP or non-GAAP in those first articles. I'm just showing what the consensus estimate was and the actual reported earnings and the difference, the variance of those percentage wise, and then the actual from a year ago from the same quarter, and the difference between that and the actual of this year. So it's, I'm just trying in those articles, I'm just trying to focus on the beat is maybe they beat earnings, but they may not have increased earnings. They may have, and again, that doesn't take into consideration all the stock buybacks. If I were to back all that out and use the same number of shares as they had, or just back out, instead of saying earnings per share, just say earnings and look at the difference, it would be even worse.
So basically, in summary, what, as all of us are investing, whether we're professionals, whether we're self-directed, we're always receiving lots of content in the news, different articles. And there seems, again, like we've mentioned, there's this tension of what's really happening in the economy. Is the market strong for good reasons? Is it propped up? And there have been narratives for a long time about, it's propped up by easy money from the Fed or by low interest rates, stock buybacks. You have a long list of things that people will say are the reason the market's high. And all of those are really artificial reasons and not true. Hey, the economy is strengthening and you should be encouraged by this. But the thing is, that's hard about those things is a lot of times it sounds like, hey, that sounds right. That makes sense. But having the data behind it to verify that can be really hard. And what I feel like you've been doing is really breaking down the information that's being reported in earnings and figure out what is the consistent, clear data saying and how is it comparing year over year and what are the trends. And what you're seeing is that the trends are that companies are progressively more and more reporting non-GAAP numbers and perceptively to cover the fact that the earnings aren't as strong as they are. You mentioned a lot of reasons. I won't recap all of them right now. You mentioned at the beginning of the interview for why that may be taking place. But the bottom line is it sounds like you found some pretty strong evidence that says, hey, there are a lot of companies out there that are not doing very well and they're struggling to hide it. Would that sound safe to say?
Yes.
Okay.
Exactly. I mean, and there are some industries that are doing okay, as I mentioned, but there are some companies that are really doing poorly, and whole industries are down. And of course, energy itself and materials are pulling down everything, but it's not just those. I mean, in my articles, I pointed out that several other industries were actually down compared to a year ago also. And this year looks like we're going to end up the year with earnings slightly below last year on a GAAP basis, which means that we'll still be below 2011 earnings. And
wow.
Compare that to the valuations. So it's all been multiple expansion, not growth in earnings, and it hasn't been growth in revenue either that much. There was from 2011, at least that's gone up, but the earnings have not kept up pace.
Wow. Well, hey, Mark, this is great research, and I really appreciate all the work you've done to do the diligence to make this research possible, or to make this data and information possible for the rest of us. Thanks for all the articles you've written up on Seeking Alpha to help us, and thanks for giving us some time this afternoon in this podcast to share some of it even more.
Well, thank you, and I hope I can be on again in the future. I do have a few things I'd like to share that are going to be coming. Some series that I intend to do more on valuations.
Great,
but anyway, it should be interesting. I'm going to try to put multiple valuations for for a lot of companies out there for people to really think about and explain why I do the different forms and which ones I use and rely on the most as far as valuation models.
Excellent. Well, I'll look forward to, glad to have you back on the show. You're, like I said, anyone doing the kind of work that you're doing is always welcome here, and hopefully we'll always continue to be able to give great information and benefit to our audience. So I'll look forward to that new series coming out, and we'll look forward to having you back.
Okay. Thank you, Brian.
Well, hope you enjoyed today's interview with Mark Bern. Remember, you can get full show notes with links and other details at investorandthefamily.com. And don't forget, you have a few days left to sign up for free for the online investing conference. Go to onlineinvestingconference.com, or you can sign up for the Investor and Family email list. Text the word join family, one word, to the number 44222. You get an email about registering for the conference. Again, that's onlineinvestingconference.com. Sign up for free up until next Wednesday, September 7th, to get the top 2 highest conviction investments right now from Brett Jensen. And after that, September 7th, the price jumps to $99, and the conference goes live on September 12th. Look forward to seeing you there. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.